Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and today we are taking a look at another requested stock. And this one's an interesting one. Definitely not a value stock, potentially a growth stock. And well, we'll see once we get into it. So today we're talking about Roblox, ticker RBLX. And it is a stock that I have heard quite a bit about over the recent years. And I was interested to dig into. So when I saw the request, I was happy to take a look. And well, this is what we're working with. So it's a company with some decent and growing revenues, a 3-year CAGR of 63.5%. In the last 2 years, that's picked up to 55%. But that is not flowing down to the bottom line. They have had negative net profit for the whole time frame that we look at, and actually, they didn't even come onto the market until 2021. So before that point, we have to just use the initial share price of $69.50 for some of the calculations here. But I feel what's really important here is the trends. So they've shown some pretty incredible revenue growth, and the cost of goods was pretty flat up until 2023, where it really hopped up. We see that gross profit's very nice, but the net and EBIT are trending in the wrong direction. So that is something that we need to keep an eye on, because looking at some of the stuff, it looks like it's headed in the right direction, but others not so much. Assets look great, but liabilities almost exactly the same. And when we look at the actual metrics here, we see that the assets and liabilities are very close together, much closer than we typically see in companies. And it's giving it a debt to equity ratio of 16 and a half as of the end of last year. And that has been on the rise, not something that we like to see. And they've actually had a negative shareholder equity for a little bit there. So definitely not good on the balance sheet front. They really need to handle that debt. Remember, we're looking for something less than 1 here. 16 and a half is insane. And then we can get into the cash flows. The cash flows are kind of decent here. This last year was a down year for them, an anomaly. But outside of that, you can see a pretty solid uptrend in the cash flows. And that allows us to run a discounted cash flow on the stock, where we're using the cash flows that they came in with. Not last year because it was that down year. We're using 2021's and then their typical rate of growth of those cash flows, which is 35.7%, because they started this in 2019 with 14.5 million and have gone up to over 500 million this last year. And running through all of the discounted cash flow, we end up getting a price of $49.97. So if you assume that they can continue to raise their free cash flow at 35%, then you should be willing to buy the stock under $50, which it definitely sits at today. With top line growing at 55%, I don't feel that that's really unreasonable, but I am a value investor, not a growth investor, so it's not a risk that I'm willing to take, especially when I see some of these other numbers and trends, because a lot of that money is going to have to go towards this debt to pay that down. Like, their debt right now is twice their revenue, which is just not a good sign. That's not a way to handle a company. Dividends are non-existent, and then we end up with the graphed prices here, where we see that there's a lot of agreement here towards the center, and the stock price is currently sitting above that. So I'd say on a value perspective, it's definitely overvalued. I mean, we can get into the actual numbers here, and you'll see that this last year was awful. We're coming up with a fair value of -$3 because the earnings gave a negative value because they came in with a $1.55 loss. The cash flow came in with a negative value because they lost $58 million. And the balance sheet was $1.53. And then there was a zero waiting on the dividend because it's non-existent. So literally the only value as of the end of last year coming for the stock was $1.53 for its balance sheet. Now, this year, things are looking a bit better. Yes, there is a higher negative in the earnings, so that is going to have an impact on them. But if that cash flow was just an anomaly this last year and they can get back to that growing at 35% like they had been, we'd be looking at a much better number, $20.50 or so of value there. And then the balance sheet, we're hoping that they're able to improve that and get it up to $11.60 in value. But that stands to be seen. This company is very new and not seeming to start out on a very good foot. But these are the types of opportunities for growth investors. If you can find a company like this that's pre earnings and they grow into earnings over time and they're able to continue that growth, you'll see exceptional gains. But that's not what we focus on here on the channel. We look at revenue is good, expenses as a portion of revenue, bad and getting worse. So that's a huge red flag. Earnings per share, we don't want to see more than 2 negatives, bad and getting worse. Earnings yield, we want to see something over 5%. We see over -5%. So that's awful. Share count growing, not what we want to see. We want to see it declining. So it fails there. Free cash flow yield this last year was negative. We don't want negative in the last 2 to 3 years. So it fails there. Tangible book value, we at least want that positive, and we do see that more recently. In the past, it was negative. So it gets a check mark there. Debt to equity, 16 needs to be less than 1. Atrocious. ROE, -302 because they have negative net earnings. So it fails on almost all tests for value. The Lynch formula says that it is incredibly overvalued. And if we were going off of the metrics that Benjamin Graham would use, it would also be a definitive no. So I see from a growth perspective the thesis here, but definitely not a value thesis and definitely not a risk that I'm willing to take. So at best, it'd be a hold. I don't think that I could give it a sell. They are growing their revenues pretty good. They just need to work on their operations, bringing down costs. But that's what we're seeing on this one. So hopefully you guys enjoyed this video. It was a quick little one. I knew right off the bat that it wasn't going to be a value play. But like if you enjoyed the video, comment if there's any other stocks that we should look at, and subscribe so you can stay up to date on everything. And I'll catch you next time.